Believe it or not, a savings account is probably the worst place to save your money. You honestly will end up losing money over time. And so today I want to talk about why that is and what some good alternatives to savings account might be for you. So let's get into it. Hey y'all, welcome back to the Inspired Investors channel, where we share personal finance and real estate information to inspire freedom. I'm Caleb, and today we're talking about a few alternatives to savings accounts because savings accounts honestly suck. And these alternatives are going to be places that will actually make you money as opposed to lose you money over time. So let's get into those. Okay, so let's first talk about why savings accounts aren't a great place to put your money. And to do this, we need to talk about two things. Number one, we need to talk about what interest is. And number two, we need to talk about what inflation is. So interest is the money that you owe to someone when you borrow their money, or that you are owed when someone borrows your money. So when you put your money in a savings account, you actually do earn a small amount of interest. And this is because when you put your money into a savings account, the bank that you put it into borrows your money and lends it out to other people. And so they collect interest on it and then pass that interest along to you. So this is great. You make a little bit of money just by simply putting your money into an account, which I think most people would appreciate, not doing much work for some money. Unfortunately though, there is something called inflation. And inflation simply means that as time goes on, the value of a dollar is less than it was before. So a good example of inflation is the price of a gallon of milk. In the early 1900s, a gallon of milk might cost you 30, 40 cents. And today, a gallon of milk could cost you $3, $4, or even $5. And so a gallon of milk will cost 10 times more now than it did back then. So in the same way, the money that we are saving now is losing value over time. And in 100 years, maybe worth 10 times less than what we actually have in our account. So inflation typically grows at a rate of 2 to 3% a year. And most savings accounts will typically give you an interest rate of 0.04, 0.05% a year. And so as your money is growing at 0.04%, the interest rate is growing at 2 or 3%. And so your money is losing value over time. So now that we got that out of the way, let's talk about a few places where you can save your money depending on your investment goals. So a few things to keep in mind when going through these options is, one, what is your risk tolerance like? Are you someone who's comfortable putting all their money into the stock market and dealing with the ups and downs of that? Or are you someone who needs something more stable? Another thing that I think is good to keep in mind is how liquid do you need to be? Meaning, how easily do you need to access your money in case of an emergency or, just to handle day-to-day expenses? The last thing is, what are you saving for? If you're saving this money in an emergency fund, you might need to keep that money liquid. But if you are, saving money for a long-term investment, maybe this is something that you are comfortable risking for that high growth reward. So we have risk tolerance, liquidity, and what's your goal. So with that out of the way, I want to talk about the first account on my list, and that is a high yield savings account. So a high yield savings account is pretty much exactly what it sounds like. It's a savings account that pays a much higher interest rate, usually like 20, 25 times higher than you would see at a typical bank. So now probably is the worst time to put your money into a high yield savings account, just because banks are still struggling recovering from COVID. But typically, a high yield savings account will put you somewhere around 1.5% to 2%, maybe more in coming years and all the fintech that's going on. But that will be great to keep you in line with inflation so that your money will appear to grow, which would be nice. But it'll honestly just be keeping up with inflation and maybe even beat it some years. So the second account you might consider is called a money market account. So money market accounts typically don't have a whole lot of interest attached to them. They're usually only slightly better than a typical savings account. And they are a little less liquid as well, meaning you may have limits on how often you can pull your money out. It may have trouble accessing your money at times, just because it's invested in money markets. But the good thing about money markets is that they do pay interest monthly, calculated on whatever your daily balance is, which can be beneficial for people depending on what your goal is, what your financial situation is. The third account on my list is called CDs, or certificates of deposits. So a CD is similar to a typical savings account in that you give your money to a bank and they loan it out. However, a CD is a locked account for a predetermined period of time, which means the bank is able to certify that your money will be there and are willing to pay you a higher rate of interest because of that. So you will be paid interest for, however long your CD term is. And at the end of that term, your account will be released back to you. So CDs are known as pretty safe investments and, not nearly as risky as stocks or bonds or anything like that, which is great in terms of safety, but also means you won't be making a whole lot of interest on this either. However, your money will grow, it'll be extremely safe, and you'll pretty much get a guaranteed rate of return. So there's a really wide range of interest rates when it comes to CDs, so it's good to shop around and get the best thing that works for you. And although you're locked into a CD, there are ways to get out in the case of an emergency or something like that. And that's another thing to consider when you're shopping around. So the next account that you can use to save your money is a brokerage account. And there's a whole bunch of different types of brokerage accounts. And for the sake of this video, I'm gonna focus pretty much just on retirement accounts. So the reason I want to talk about retirement accounts as opposed to other brokerage accounts is that I don't want people to get caught up in things like day trading and all that that's associated with a traditional brokerage account. I want to talk about saving for the long term, which is exactly what retirement accounts are structured for. Because of that, they also have a lot of tax benefits. So there's a super long list of different types of retirement accounts as well. But for the purpose of this video, I just want to give you guys a few examples of things that you can look into and start to, think about for yourself. And those things are your employer-sponsored 401k or 403b. With those, there's typically, you put money in when you get a paycheck and your employer typically matches you, which is really nice. It's free money, so a great thing to take advantage of. And there's also things like Roth IRAs and even, solo Roth 401k. They get really creative with these types of things, but I think it's important to look into definitely those 3 or 4 that I just mentioned and just start to kind of put together in your head what makes sense for you and your financial situation. Choosing a specific type of retirement account usually boils down to how much money you're contributing and how you want to pay your taxes. And so I'll make a video detailing more information about retirement accounts if you guys are interested in that. Just comment retirement in the comments, and if people are interested, I'll definitely make a longer video about retirement accounts. So anyway, having a brokerage account or a retirement account is going to allow you to start investing in things like stocks and things like bonds. And stocks, if you're not familiar with them, are tiny pieces of equity within a company, which is a tiny piece of ownership. So when you buy a stock, you buy into owning, let's say McDonald's. And if McDonald's does well, then they are worth more as a company, which means your stake in ownership or your stock is then worth more money. So you can then trade your stock or, hold on to it and just let it grow over time. But the point is, you will earn money if a company does well. You'll lose money if they don't do so well. So bonds are a little less mainstream and maybe a little more complex. Basically, they are an IOU from a company to the person who bought a bond. So I like to think about bonds as being similar to mortgages. When a company is in need of some money, it will issue bonds to investors, basically saying, hey, I need X amount of money over a particular period of time, and I will pay you back at a later date. So when that later date comes, the company pays the bond in full, but over time, an investor is given what's called a coupon, which is basically interest. So the company is paying you interest over time and then giving you your principal at a later date. So the next account I want to talk about is a healthcare savings account. And this is an account that is triple tax advantaged, meaning that you're not taxed on the money that you put in, the money that grows in it, or the money that you then take out at a later date. And it's designed for people who are looking to save for health-related expenses. So HSAs are pretty similar to different retirement accounts. A lot of times your employers will even match you on your HSA, so that's something to look into. But yeah, they work in a very similar way in that you put money into them. Your money is then invested either by you or by someone else, and your money is growing over time. And so when you need it in case of a medical emergency, or if you are someone with health problems, or maybe something runs in your family, it can be a great option for saving for those expenses so that they don't have to come out of pocket at a later date. So another place I wanted to mention that you can put your money that's not a savings account and really not an account at all is real assets. And I wanted to include that on this list because I think it can help you, again, just get more creative about what you want from your financial life and how you choose to get there. So putting your money into buying things like gold that will appreciate over time, or real estate is another good example that can even give you, dividends, so to speak, over time if you're buying and holding and renting. These are ways that you can put your money into something and still be able to access it at a later date and get a little more creative than you can with some of these accounts. So another one of these non-traditional places to put your money is actually life insurance. And beyond the whole aspect of leaving money behind for your family, life insurance is actually a good place to save, store, and use money while you're alive as well. So this is a way that's getting a lot more popular as of lately. I think because people like me talk about it on YouTube and Instagram and things like that. But it's actually a really cool and really beneficial way for you to grow your money and get a guaranteed rate of return, but also still be able to access your money tax-free and grow it tax-free. And so this is something that I hope to be doing myself. And so I'll let you guys know how that goes and what I learned and keep you kind of updated on what that looks like for me, and maybe it'll work for you as well. So if this video was helpful for you, be sure to like, subscribe, and share this with someone else it'll be helpful for. And turn on the post notifications. We drop videos every Wednesday. As always, super appreciate you guys watching, and I'll see you next time.